Hello investors and future investors, welcome back to the channel. Today's video will define and give examples of what it means to be a smart investor. We have a goal that at the end of this video, you should be able to make strategic investment decisions that will propel you to wealth creation. So whether you're a seasoned investor or just starting, understanding the principles of smart investing is crucial for building and preserving wealth. Go ahead and grab writing material because you surely will want to make notes on exploring smart investing and its key components. Welcome to Investment Gains. Let's jump right into it. To start off, let's first define what it is that a smart investor does. Smart investing goes beyond merely buying and selling assets. It involves a strategic approach to grow wealth over time while minimizing risks. Instead of relying on luck, smart investors use research, analysis, and careful decision-making to make informed choices. This approach considers long-term goals, risk tolerance, and the overall economic climate. Now let's explore the 4 key components of smart investing. Number 1. Diversification. One fundamental principle of smart investing is diversification. Spreading your investments across different asset classes, such as stocks, bonds, and real estate, helps mitigate risks. By not putting all your eggs in one basket, you can buffer against market volatility and potential downturns in specific sectors. Think of diversification as spreading your risk amongst various asset classes, so if one is negatively impacted, then the others maintain your portfolio until the negative one changes course again for the better. Number 2. Research and due diligence. All smart investors dedicate time to research and due diligence. They analyze financial statements, market trends, and economic indicators to make informed decisions. This thorough examination helps identify opportunities and potential pitfalls, guiding investment choices. Smart investors make informed decisions based on their research and due diligence, and not from word of mouth or whispers from friends or family. Remember, research and due diligence takes time, so if you find yourself making a stock market investment decision quickly, then you may be trading and not investing. Number 3. Risk management. Understanding and managing risks is paramount in smart investing. Assessing your risk tolerance and having a diversified portfolio are crucial components. Smart investors also employ risk management tools, such as stop-loss orders, to protect their investments from significant downturns. Understanding the risks associated with your investment means that you know the consequences of your decisions, whether positive or negative. Managing your risks, however, determines what actions you take when a certain outcome has been met. Once again, whether this outcome is positive or negative. Number 4. Long-term perspective. Unlike speculators who focus on short-term gains, smart investors adopt a long-term perspective. They patiently weather market fluctuations, capitalizing on the power of compounding over time. This patient approach allows them to ride out market volatility and capitalize on the growth potential of their investments. Investing involves long-term objectives, and if the objectives are of a short-term nature, then future investors, you have stepped over to trading and not investing. Now that we have identified the key components of smart investing, we will go into real-world examples of smart investing. One very good real-life example of smart investing would be value investing, and there's no one better at this than Warren Buffett. Warren Buffett is one of the most successful investors of all time and is a prime example of smart investing. His strategy revolves around value investing, where he seeks undervalued stocks with strong fundamentals. By investing in companies with a durable competitive advantage, he aims for long-term growth. Warren Buffett waited 8 years between investing, and during this time, he was ridiculed and laughed at. The word around town was that he had lost his investment edge. But when the recession hit, he was sitting on $150 billion of cash reserve and was able to buy value stocks at a very low price due to inflation. Buffett's Berkshire Hathaway portfolio includes iconic companies like Coca-Cola and Apple. Another good smart investing example would be index fund investing. Index funds are mutual funds or exchange-traded funds that match or track the components of a market index. An example of a market index would be the S&P 500. Index funds investing, however, happens when an investor buys an index fund like the Vanguard S&P 500 ETF, VOO, which tracks the S&P 500. Index funds offer a passive investment approach, tracking a market index performance. This strategy, championed by investors like Jack Bogle, minimizes fees and provides broad market exposure. Smart investors often include index funds in their portfolios to benefit from overall market growth with lower management costs. Yet another example of smart investing would be real estate investments. Real estate is a tangible and resilient investment class. Smart investors diversify their portfolios by including real estate assets, whether through rental properties or real estate investment trusts. This strategy provides a steady income stream and potential appreciation over time. Real estate investing involves buying properties for rent, whether for commercial or residential purposes. An inexpensive way to begin your real estate journey would be to invest in a real estate investment trust, which will give you passive investment gains. Our last example of smart investing would be dividend investing. Dividend investing is hands down one of my favorite smart investment types. This type of investment involves allocating a portion of your portfolio to dividend stocks, which pays you cash on a regular basis without any additional effort from you. With dividend investing, like any other type of investing, I would highly recommend doing your own due diligence prior to purchasing dividend stocks. A few dividend stocks in my portfolio are Coca-Cola, which pays me upwards of 3% dividends, Reality Income, which is a real estate investment trust paying almost 6% dividends, and Omega Healthcare that pays a dividend upwards of 8%. Being a smart investor would require more than just the 4 key components mentioned before. It would also require a mindset shift, which I had to do myself before I found success. On my path to a mindset shift, there were a few books that helped me big time, and one of these books was The Intelligent Investor by Benjamin Graham. So I would highly recommend you adding this book to your book list. To conclude our video for today, I would like to mention that smart investing is a disciplined and strategic approach that considers diversification, research, risk management, and a long-term perspective, not to mention a mindset shift. Learning from successful investors and applying these principles can significantly enhance your investment journey. Remember, the key is to stay informed, adapt to changing market conditions, and remain patient. Always remember that smart investors keep it simple. If you found this video helpful, don't forget to like, share this video with someone that can benefit from its content, and subscribe for more similar content. And until next time, keep pushing your investments.